Hello everyone. So this is my third video to my 5-part series of the different types of life insurance. So to begin, I want to go over again that there are two types of life insurances. And it is the term life insurance and the cash value life insurances. It's two categories. So you can think of term life insurance as basically renting a house. You don't get no cash value and it's for a term. After the term, it may be 1 year, 5 years, your rent go up. Same thing as term. Your term life insurance goes up compared to how old you are. And then the second type of life insurance is the cash value. Everyone knows it's whole life or permanent life insurance. You get cash value. So in this video, I want to go over the universal life insurance. There are 3 different types of universal life insurance. So there is the regular universal life, the index universal life, and the variable universal life. So with just the regular universal life insurance, the premium that you pay is flexible. So if you come into hard times, you can pay less than what your policy was set up for. So the premium itself is flexible. Payment period is for a specific period as well. And then after that specific period is over with, you don't have to pay anymore, but your policy is still in place. So you can, so with the universal life, it's all about when do you want to stop paying into your policy and just have the policy there. With the universal life as well, you can build cash value. The interest rate declared by the insurance company can be 2 to 5%. So whatever the interest rate it is at the time that you open your policy, that's the interest rate that it's going to be. Death benefit, it can vary at the discretion of the policyholder. Far as the death benefit, it can increase depending on your cash value. So your cash value can be added into your death benefits. Also, for the purpose of the universal life insurance, protection is protection for life with higher rates of return on cash value, so that the policyholder only pays for a specific number of years, and then you can keep your policy. This policy is not designed to be used as a retirement income strategy. So it's basically just for cash value and the death benefit for just the universal life insurance itself. So some pros and cons of the universal life. Some advantages. You get lifetime insurance protection. Usually with the whole life insurance policies, just regular whole life insurance policy, your policy matures when you're 100 years old. So they say that it's for life, but it's not for life because they're going to start trying to give you your money, some money back when you're actually at 100 years old with a whole life insurance policy. Also, premium and death benefit, again, is flexible. If you come into hard times, you can pay a minimum on your policy. They will it's however your policy is set up. This is for the universal life. And then cash value growth reflects current interest rate with a minimum guarantee. So the current interest rates for when you sign up, that's how much your policy is going to be worth. So you're going to be getting money over time. But they do have a minimum amount of interest rate that's going to be guaranteed on your policy as well. Disadvantages of the universal life insurance. Required premiums may increase as the insurer gets older in order to maintain needed insurance protection. So it can increase. But when it increases, you still have the specific time period where you can just stop making payments as well, and your policy still will be in place. If current interest rates are low, cash value growth may be disappointing. So it all depends on the market with the universal life insurance. The interest rate is fixed is basically fixed, but the companies will have a guarantee of insurance. So this is my detailed video of universal life insurance. If you have any questions, reach out. Let me know. My contact information is everywhere. Email, two, three different types, or you can call me directly, 410-908-7865 for myself. All right. See you in the next video.